Back live on another episode of the Lone Star Capital Podcast. Your host, Craig McGrother, the Director of Business Development at Lone Star Capital with Rob Beardsley, the CEO and co-founder of the firm. Coming off a very productive stretch here after Raise Fest and Best Ever Conference. It was excellent to see so many awesome people who we're in communication with, our kind of peers in the industry, the people we get to work with, and everything in between. So lots of fun, lots of work. I was absolutely exhausted coming back Wednesday, going, 9 a.m., waking up before that, obviously, starting our meetings, and then eating late dinners, which staying up till 11 is not as bad, but eating late and eating at like 9:30, having dessert, stuff like that, which you weren't eating because you're on Lent, but I was eating and everything else before that really disrupted the sleep. But we're back.
At least we don't, when we wine and dine our investors, at least we don't whine,
Yeah,
because you're not drinking, I'm not drinking. So
yeah. And
that's
it's
the
not a
extra.
whine. I'm not whining about doing it. I love it. I love the game. However, I was beat up. I was shot. Being mentally on like that, it's even for a social guy like me, it takes its toll. But it was awesome. It was super fun to have the sheriff in town with us as well, Sam Morris, who is the newest member and our partner to our team. At this point, you have listened to the first podcast we did introducing Sam to the team. He's just going to be such a resource for our investors, our capital partners. Having him come to the team was amazing. We'll probably get into that, but Rob,
Yeah,
first,
if someone doesn't know what we're talking about, please go watch the previous episode of this show. So the Lone Star Capital podcast from the week prior. That's where we're at Best Ever, and we basically introduce our newest partner to the firm, Sam Morris.
yeah, go back to episode 85 for those who are wondering. But that said, super, super great time there, connecting with everyone, whining and dining, as we like to do. But Rob, let's just get right into it. BEC recap. What was your takeaway?
So first off, what is BEC?
Yes.
So BEC is the best ever conference, and while that name is not very descriptive, uh, this conference is basically kind of like the NMHC of retail investors. Now, what is NMHC? Right? People who have no idea what we're talking about, we have to keep explaining. So NMHC is basically the National Multi-Housing Council annual meeting that occurs every year, sometime around late January, early February. And this is kind of like a must attend for everyone in the multifamily industry, from brokers, lenders, operators, managers, and service providers. So it's a massively attended event. It's institutional. So you've got the biggest owners in the country, the biggest lenders, the biggest players. People do fly in on their private jets, and so on and so forth. Best ever conference, as Craig is now sharing on the screen for those watching on YouTube, is similar, but it is, I would say, it's most certainly sub-institutional, and it's more geared towards kind of retail investors, more geared towards syndicators and people that are kind of newer, more novice in the business, which is not necessarily a bad thing. There's plenty of wonderful things associated with kind of playing in this retail space rather than playing in the institutional space. So anyway, we go to this event every year because a lot of our partners who invest with us, who raise capital with us, they attend this event. So it's a perfect opportunity for us to have meetings. So for everyone listening who we met with, it was great to see you. And obviously we took out investors for dinner as well and stuff. So
Yeah,
very fruitful.
if you're fishing in the kind of retail capital bucket, if you're fishing in the syndication bucket where you're, seeking fund managers or co-GPs, people of that nature, this is probably the conference you're going to. But it really is a melting pot of the entire kind of syndication industry. Obviously, groups like us will, have historically have raised institutional capital, will raise fund-to-fund capital. We love our, in-house kind of typical 50K to 500K LP investor who was there. So it's kind of a colorful picture of all those parties mentioned, service providers, a lot of service providers this year, which we'll get into, but just further context, that who is there. And if you're kind of in our pond, you will likely be here. It's really Raise Fest and Best Ever is some of our biggest connections, which we spoke about Raise Fest before, I believe. But Rob, get into your thoughts here.
Yeah. So this event is well attended, and it's not just multifamily, although that is the heavy slant there for multifamily, but there are other asset classes represented as well. But the notable things as far as this year's event was the decline in attendance. So we saw maybe a decline of about 50% in attendance. And obviously,
And by the way, that's our eyeball test. That may not be fact, but that's how it at least felt walking through the hallways. Because there's been times where you can barely cut through the crowd, and this time it wasn't so.
yeah, so it's just the way that it felt to us, and also the kind of the makeup of the crowd. A lot of people that we didn't recognize or just not really sure who's here anymore, and that's not necessarily a bad thing. It's the cycle of the market. There's new people coming, some people leaving, but that was a noticeable change, and I don't want to. I certainly wouldn't ascribe that decline in attendance to anything on the part of the organizers of the event. I'm sure the event just continues to grow in its reach, continues to grow in its capabilities. So I think the decline in attendance is solely due to market forces, and specifically, I think what we're kind of continuing to go into, and perhaps nearing a bottom, which could be now, could be 6 months from now, could be a year from now. But I think we're approaching essentially the retail sentiment bottom, which is what I'm calling it. Because we, and it's funny because you and I for a long time have been talking about it's getting harder to raise capital from retail investors. And we've been saying that for at least the last 2 years, right? So it's only gotten harder and harder and harder over successive years. And why is that? It's because a lot of retail investors who invested in 2021 and 2022 are now dragging out in deals that are kind of zombie deals that haven't paid distributions for a long time, or there are capital calls, or there's foreclosures, or there's outright sales for hopefully not too big of a loss, but sometimes a complete loss, which is things we've heard from certain investors share stories with us investing with other sponsors. So when that occurs, that's going to be damaging to the psyche of investors. And so here we are in 2025, you're an investor, you're not super happy with the outcomes of your investments in this industry. So perhaps you don't go to Best Ever Conference. Or a different way is you're a capital raiser, you're a fund manager, or you're a sponsor, and you kind of were leading these poor outcomes. And so you brought investors into deals. It didn't work out. You lost investor capital, or there's big capital calls and write downs and things like that. And again, you don't have money to spend $5,000 to fly and spend a couple days in Salt Lake and buy an expensive conference ticket because your business isn't going well. So I think we continue to get kind of worse and worse in investor psychology. And the big thing I want to point out is it's not that prices are continuing to go down, right? Prices already went down a year ago or more. And I believe personally that we have seen a bottom in pricing and that we saw a cap rate high. And
And let's talk about when we saw that real quick. So we saw that we believe that at the end of 2023 and perhaps Q1 of 2024, we saw the fundamental bottom, if you will. But now, as you're going through here, we're seeing the sentiment bottom. We're seeing people starting to feel the effects of capital calls, of foreclosures, of thinking that multifamily investments, although you liked it when it was a 3 and a 4 cap, is a bad investment, yet you're refusing to get into it when it's a high 5 or a 6 cap, is a bad idea, which is butt backwards, as a polite way of putting it. You think, if you were doing that then, you should just never invest in multi again. But sorry, I hijacked.
no, no. So this is a good point. We're trying to build up these talking points. So yeah, I just want to make that point clear that there's a difference between the fundamental, well, and let's be really careful with our words because fundamentals are different than valuation. So what you were saying is call it Q4 23, Q1 24, we saw a bottom in pricing, so in valuation. So we saw a peak in cap rates.
Liquidity was probably at the bottom from an institutional perspective. No institutional group in town was really saying yes to anything. And we know this because we had some impeccable deals to which, it wasn't good enough for them at that moment, but they would probably do anything to get in bed with those deals now, right?
Yeah, I mean, things move rather quickly. But yeah, and some other things that were interesting in Q4 of 23 is that's when a lot of these debt scandals were coming to light. So Fannie and Freddie were really buckling down in response to that because it came to light that there were certain, mortgage banking or firms, broker firms that were committing mortgage fraud and things like that. And so then Fannie and Freddie really tightened up their lending requirements, really tightened up their due diligence and things like that. And, that reduces liquidity. And so we saw a big reduction in liquidity, which pushed cap rates higher. And so that was the peak there for cap rates, which is inversely a bottom in pricing, unless you have a dramatic shakeup in NOI. NOI is fundamentals, right? And so the fundamentals have continued to languish because you've just basically have had essentially flat rents for this whole time, and expenses are probably modestly creeping up as well. But now we talk about sentiment, because sentiment moves very slowly. Pricing moves fast, especially in the public markets. Like, I mean, literally, look at the stock market. Prices change every second. In the private markets, like for real estate, prices move slower because it takes months and months to close transactions and things like that. And it takes even longer for someone to capitulate and sell, which actually bleeds some psychology into pricing much faster. But psychology takes a long time to change because it really takes a long time for an investor to realize the deal they invested in 2022, not a good deal, doesn't go well. And then now they're upset. Now they don't have the capital, and now they don't want to invest. And so now it manifests itself by not going to best ever, right? Just as a kind of oversimplified example.
The Venn diagram of sorts.
A
Yeah.
really important point, you kind of touched on this, but I really want to hammer this, and I'm actually going to record a Founders Insights hopefully today on this topic to really hammer this point. But this is the point of riding the wrong side of the investor psychology cycle. And so you have investors who, by sheer bad luck, timing, perhaps, they invested in 2021 and 2022. And let's say that's when they got into the business, right? They just finally, somebody convinced them. They said, hey, you should consider these alternative investments. These are private investments. They have tax advantages. They have monthly cash flow. It's
Or
really great.
maybe the market just got hot and you didn't know about it or realize it's a possibility. And then, of course, when things get super hot, whether it
That's
be
when
a
you hear about it.
cryptocurrency, that's when you hear about it. And you're not a bad person for that. You hear about it when you hear about it, right?
Right. So that's kind of what happens, right? The marginal investor gets attracted into something when it's at its most hot. And
And
that's the worst
shiniest.
time to invest in something, right? So you get sucked in, you invest in deals in 21 and 22. Those deals are now not going well. It's 3 years later, and you may have again seen no distributions, capital calls, foreclosures, loss of investor capital. Okay. Now that those negative outcomes are causing you today, the Mr. Investor in 2025, to say, well, you know what? I tried it. It's not good. It's not for me. To heck with this. I'm not going to invest in these deals anymore. And now let's just take my point at face value. Let's just say that 2025 is actually a wonderful vintage to be investing into new multifamily deals. Let's just say that. We don't have
Not
to
new, like, hey, ground up development. This is just an
making new
existing
investments.
structured property, putting fresh capital, fresh dollars into a deal in 2025, juxtaposed to 21 or 22.
Correct. So because the cycle has reset, prices have come down, the fundamentals are set up in such a way that if you invest in 2025, you'll likely see much better outcomes than investing in 2022. So, but this person who was scorned by 2022 is not going to invest in 2025. And then what's going to happen is perhaps this investor is going to let some time go by, 25, 26, 27, and then maybe by 2028, they've woken up from their depression and they've also saved up some money. And now they're kind of looking around, and multifamily investments or whatever investment you want to talk about is hot again. And people are sanguine, people are optimistic, people are making money because people invested in 25. Now they've got an exit in 28, right? And they 2x their money in 3 years. Oh my gosh, 2x in 3 years? Sign me up for that. That's amazing. So then finally in 2028, this investor who was burned by investing in 2022 is ready to try their hand at private investments again. And so they invest in 2028. And guess what? I'm not calling for 28 to be the top of the cycle, but maybe 28 or 29 or 30 are closer to the top than they are to the bottom.
Yeah, it'll be a little
Whereas
frothy again.
24 and 25 are much more arguably close to the bottom than to the top.
And what's going to happen is those people who get back into it, the same kind of mindset, they're going to get stuck in this loop of trying to find the riskiest deal plan because they didn't get in early, they didn't compound their dollars correctly, and they're going to get suckered into the deals that are going to get wiped out in the 21 and 22 cycle as well.
So
Don't be
you're
that
stealing my
person.
punchline. You're stealing my punchline.
Ah,
So so yeah,
we're
so the
so in
guy
sync. Sorry, I apologize.
no, it's fine. So the guy invests in 28 or 29 or 30, right? And like you're saying, you're actually making a really good point. They heard about why are they getting back into multifamily, right? Because they swore it off. They said this doesn't work for me. I got burned on this. This is bad. So why are they getting back in? It's because they heard of someone getting a 2x in 3 years because they invested in 2025 when the cycle was bottoming, when things were cheap. And so they're like, give me some of that. So then they go into the market in 2028, 29, 30, and they're saying, who can give me a 2x in 3 years? And then, some firm that's going to come around, beep, and they're going to say, yeah, we can give you a 2x in 3 years, right? And guess what? At that point in the cycle, it's not going to be realistic to project those returns or achieve them. So that's going to force you to invest in the riskiest of investments at the time where your risk posture should actually be defensive. Because when the cycle is high, valuations are higher, there's more risk embedded into the market, right? Cap rates are
And
lower.
what happens as well is when these things start to occur, when people start 2xing their dollars, the newer operators come in who get access to not as good of quality of deals that need to raise money by promising you the moon, sun, and the stars in another galaxy. They come into play, and you start seeing new sponsors popping up with very, very risky business plans to achieve their raise or to kind of get you involved into that opportunity or deal by promising you so much or saying we're going to do X, Y, and Z, or projecting, maybe I should say is a better word, perhaps. Hopefully it's not a promise, but projecting very lofty numbers, right? That's the perfect storm of the makeup as to where we were before. These aren't, market agnostic investors, dollar cost averagers. These are hot money people.
Yes. So our example, Mr. Investor, which we hope that all you listeners, this is not you, and we know it's not you because you're listening to this, but our example, Mr. Investor, by 2030, right, they're going to be looking around the market and they're going to talk to us because we've got a good reputation, we have good branding, good marketing, and they're going to come.
Market cycled, market tested.
Sure, we've got all the makings of a great sponsor that you should partner with. And so in 2030, they're going to reach out to us and say, "Hey, I'm interested in investing now. I've heard great things about investing in multifamily. In 2022 it didn't work out for me, but that's almost 10 years ago. I think I'm ready to go now." And we'll say, "You know what? Wonderful. We are investing in lower leverage, higher quality assets, long-term holds because we feel like the market is kind of at a more top rather than the bottom. And so we're projecting, let's say, 7, 10-year holds and a 12% IRR." And they're going to say, "What? I didn't get into this multifamily game for a 12% IRR. I want to 2x my money in 3 years." And so they're going to not invest with us and instead invest with the player who's going to take inordinate amounts of risk at a time when your risk posture should be defensive. And they're going to be doomed to repeat the cycle again and have a bad outcome when the cycle again resets. And then they're going to be scorned. And then it's going to be over and over again. And this is exactly, hold on, let me finish my points here. This is exactly the psychological process, the cyclical psychological process that condemns an investor to buy high and sell low forever. And I'm going to capstone this point with my favorite data to back up this point, because I can say this until I'm blue in the face, but the reality is until you've lived through a cycle, which I'm not claiming to have lived through a cycle, I'm 28 years old, but we're living through one right now. But it's so hard to convince someone of this until they've really lived it, until they've felt it. But a really good data point is the Magellan funds, which were headed by Peter Lynch. Peter Lynch is one of the most famous mutual fund investors of all time. And he took over the Magellan funds in 1977 and he managed them until 1990. He has one of the best track records in investing history because his funds that he managed through that period of time had an average return of 28% per year. So he was crushing the market. He was absolutely doing an amazing job. However, the average investor investing in the Magellan funds during that time period, believe it or not, actually lost money. So how can a fund which performed on average from 1977 to 1990 got average returns of 28%, but the individual investors on average who invested into that fund actually lost money? It is because they invested in the fund at the wrong time and then they sold out at the wrong time. And that is the cyclical investor psychology process that we just covered. And so it's very sad because when the Magellan funds were outperforming because they did like 60% in one year, everyone said, wow, Magellan funds 60% last year. I've got to get some of that. I'm going to invest right now, right after they just did the 60%. And guess what happened the next year? It was minus 12%. So what did a lot of those people do? They sold and took their 12% loss and said, Magellan funds, I guess that's not for me. And they're on to the next. So I really hope that that sticks and resonates with people. I think it's super fascinating, and it's very, very difficult to invest because you're going against your psychological tendencies.
But Mr. High Quality Sponsor, you're projecting a 10 to 12% return over a 7 year period, 10-year period on a hold here. Uh, well, what am I going to make on that? It only shows I'm going to make 7 to 8% on my dollars raised here. That's not enough money, Mr. Seller. Will you give me a better split here on this?
Well, that's a whole other topic of conversation, which is fraught in itself. And I made a video about this. I think I was in where was I? I was in Vail. So that was a super fun video to make up in Vail, talking about how fund managers need to really think from the perspective of an investor, and that when a fund manager is investing, they need to think about their compensation as an investment, right? Because
Yeah,
it's not guaranteed that they earn that promote.
yeah, let's not get into a additional rabbit hole, but that rabbit hole is next door neighbors to the conversation we're having right now. It's certainly of the same vein in many respects. So yeah, I just think that the important thing to think here is, just as we relate this back kind of full circle, best ever, an amazing event. You should be there now more than ever. You should be trying the right partners, but the room and the interest indicates that, well, it's not a good time to be in the market. Well, it's not a good time if you chose the wrong deals with the wrong plan and structure. And for those who maybe be struggling, perhaps through this time, maybe they're a newer sponsor manager that came in the 21 and 22 era. Keep your head high. Realize that you're not alone on these capital calls or foreclosures. There's still a possibility for you to make right, but it's going to take some time, and you need to be buying right now and raising right now. And if you're a capital raiser, the message we have for you right now is, don't get discouraged by maybe some stuff that's going on. Reevaluate your plan and how you're going to make money on the next business plan here. That's not a one size fits all for a value creation perspective. So I encourage you, if we have not been speaking, if you haven't seen some of the stuff I've been up to, or we've been up to, I should say, as a firm, please reach out to myself, and I can kind of break down how we're able to make a buck and do really smart things during a different part of the cycle, because every cycle presents a different opportunity for an investor or a manager, general partner, to create value and to make returns that are disproportionate when the market is shifting, when people are kind of getting hurt. And as I said, just full circle, the thought to take here is, be investing during times like this. I'm only telling you to do what I'm personally doing here, which is investing a disproportionate amount of my investable dollars into this asset class. Another theme as well is, if you think the stock market's such a good investment right now, obviously these last couple of days it's been not in the best place, but it's super high, just generally speaking. The multiples, as you say, Rob, are a little bit frothy on that end right there, right?
Yeah, the PE
Stocks.
ratio for the S&P 500 is 28 right now, and essentially in all times in history when the PE ratio has been this high, and then you invest in the stock market today when PE ratios are this high, over the next 10 years, the stock market on average does -2 to 2% returns.
Yeah. So with that said, stocks are at an all-time high, and alts right now is going through depression. So this is a great time to kind of be contrarian, and being contrarian oftentimes during opportunities like this generally gives you a very, very good outcome and performance. So there is our rant and TED Talk on that front there. Really cool subject here, switching gears, or not cool, I guess, depending on how you look at it. But finally, some information and data that really kind of suggests that we perhaps are in a worse spot than we've been in for many reasons. So without further ado, let me try to find the correct web browser here.
Yeah, so I'll kind of riff while you're pulling stuff up. So this topic is related to a conversation we had with our good friend Jeremy Roll at Best Ever. Jeremy Roll is I want to say, in our space, a legendary LP, if you will. Very savvy guy, very conservative guy, very economically minded. Him and I have had long conversations about the economy and the workings of the market. And we discussed, and I kind of put forth to him the possibility, because he's kind of still waiting for a recession. And I put forth the possibility that perhaps we not only are currently in one already, but perhaps we already had one in 2024. And I think the data has been so manipulated. You're hearing things from different sources. I think it was Macy's was saying that holiday spending was really light. That's their Q4 report. I just do think that in 2024, we saw a contraction in the economy. I think nobody was hiring, especially for skilled labor. So I think the reason why we're having these conversations and these confusions is one, the government manipulation of the data, but two, more importantly, the inflation and the money printing that was done coming out of COVID, which has distorted what how a normal recession would play out. I think, because what is a recession? A recession is a decline in essentially economic prosperity, right? And so I think we've seen a substantial decline in prosperity in this country, not by way of necessarily people losing their jobs, although there has been some of that, but more so in their decline in their purchasing power, right? There's been so much inflation. There's been just a step function increase in cost of living that effectively serves as a recession. So I think I hate to say that this time is different and that we are not going to or have yet to see a classical recession in this time. I just I just think that people are underappreciating, especially relative to the market cycle, the economic conditions of the last couple of years. And if I'm looking at asset prices, if I'm looking at investor sentiment and activity, I think it's going up. So I think we've had the recession, the bottom, the whatever, and I think things are going up. Prices are going up, competition's going up, right? We're bidding against people again. There's other bidders in the market for property. We're in best and finals. Prices are high. We have to, you know, sharpen our pencil to win deals. So I think things are on the up rather than being high and waiting to crash.
So, for those who are only listening and not watching, what I have screen shared right now is from the Atlanta Fed. And this says on March 3rd, the GDP model now forecasts of real GDP growth in Q1 2025 is minus 2.8%.
Yeah, that ought to get bond yields to rally.
Yes. So that said, that would obviously be a signal of a recessionary time. I think we've all felt our dollars not go as far, which, there's been a ton of money printing. Really, those who have had assets are doing better. And, it's tough for those who maybe are asset holders to say, well, of course not in a recession. Look how rich I am now, right? Because everything's been inflated to the gills. But for the everyday American, which is most applicable to, are struggling more than ever. It's very tough there on that front. And these are kind of just the tells and the signs. And I think another thing that's interesting, and we'll see this play out in real time, but our friend Jeremy, and this is just a micro kind of cosm of what's happened in the marketplace. Investing in multifamily was a lot more straightforward and easy to say yes to stuff when you had such great positive leverage, right? So Jeremy Roll has a typical deal or kind of thought, which is an awesome one. I wish we could do it more often, but I don't know if that market would ever come back for looking for 150 basis point spread of your going in cap rate to exceed the interest rate. So for simple terms, he would feel comfortable investing in a deal if it was a 5% interest rate to do a deal at a 6.5% cap rate. I don't know if that market will come back where there's spread there in growth markets. Perhaps you can look for more tertiary and secondary markets where you're going to be accruing a lot more risk if you want to going in cap rate of that nature there. But I think the days of the spread kind of being like that are, in my opinion, perhaps no more, just due to the fact that there's so much more investment interest in this kind of product type there. I think the alts as a space, the alternative investment world, is becoming a lot more mainstream and not so alternative as it used to be. So I think those are some stuff that are generally changing now versus what it's been historically. And the other thing to think is there's so much money on the sidelines for good product and whatnot, whether if you're an institutional investor, stuff like that, that it's just going to bid deals up enough where there should be, in my opinion, no crazy fallout more than we've already seen with regard to where cap rates could potentially go. I'd be curious to hear your comment, Rob.
Yeah, you covered a lot of ground there. This GDP Now forecast, which shows Q1 2025 GDP projected as minus 2.8%, that is very interesting. And I don't know if it doesn't necessarily actually kind of corroborate my position, because this could potentially say, hey, actually, we're going into recession, let's say now or in Q4, because obviously we need to look at not nominal GDP. Well, this is real GDP growth, so I guess this is factoring inflation. So yeah, this would kind of basically say, yeah, the recession's starting now, and so I believe that makes sense. That's we've been waiting for it. I don't think it's going to be very damaging to fundamentals as far as multifamily is concerned. Uh, but yeah, this is kind of what Jeremy has been waiting for and others have been waiting for. Like, hey, we had the inverted yield curve. Now where's my recession?
Right.
Right. And so here it is, perhaps. And so that doesn't necessarily mean that prices are going to go down, because that's just not how things work. They don't move in lockstep, right? You have a valuation cycle market, you have a fundamentals market, you have the interest rate cycle and the sentiment cycle. And so not everything is perfectly tied together. So that's an interesting point here. And the connection here is we were talking about how a recession is probably not going to be super damaging to multifamily fundamentals, because I don't think rents have already been going down, right? And why have rents been going down? Well, they've been going down for the last 2 years because of supply. And so what's going to happen over the next 2 years is no supply. Just, I'm oversimplifying, right? So while the economy may be in a recession, we're also going to be an undersupplied situation because nobody's been building. So rents are going to be buttressed by that factor, but then maybe obviously pushed downwards by a recessionary environment. But with all that being said, I think multifamily is very robust and is going to handle the recession very well, which is exactly why cap rates are going to stay low. Because time and time again, multifamily has proved itself as a resilient asset class, which is why all the capital has flooded in. And so what you have is a situation where, why should a multifamily owner be able to buy a property with 150 basis point positive leverage spread over and above their interest rate if risk is known and considered low? If the consensus out in the world is that multifamily is a great investment, then there's going to be competition for that limited source of assets, and people are going to be willing to pay not a 6.5 cap and finance at a 5. They'll be willing to buy at a 5 and finance at a 5, because they'll be happy with neutral leverage, and they'll say, yeah, I'm very happy to get a 5% cash on cash on an asset that I feel very comfortable with, that is an inflation hedge, that performs well in recessionary times. My multifamily performed well during COVID. My multifamily performed well during the great financial crisis, and it's going to perform well in 2025 and most certainly 26 to 27 when we have undersupply and high rent growth. So that is why, to your point, I don't think we're going to see this big reversion to, oh, well, multifamily just has to go back to the days where you've got 150 basis point spread between your cap rate and interest rate. I think,
And we would love that for our record, because we're not going to be selling anything here coming up. We're going to be net buyers here in the moment. So I wish upon all wishes that we could find those opportunities, and we could probably get there via tax exemption opportunities, which is kind of a manipulation there, a little engineering of sorts with regard to that spread. But on just going in numbers doesn't really seem very realistic or practical.
no, you'll have to compromise on quality. It'll push you, if you hold fast to this requirement, it'll push you out into tertiary markets, into older properties, into less desirable properties. And so when you can't achieve the returns that you're looking for, one of the worst things to go do is to push further out on the risk spectrum to try to go and get those returns, because the higher risk you take doesn't necessarily mean the higher returns you get. It's the higher returns that you can get, but also you have now increased your possible outcomes, both in the positive direction and in the negative direction.
Yeah.
So this is actually very similar to Howard Marks and his memo that literally just came out, talking, I think the title of the memo is Gimme Credit. And so Howard Marks is the most famous bond investor, one of the most famous bond investors of our time. And so he focused on high yield bonds. And so in the high yield world, you're investing in non-institutional companies and you're lending them money at a risk premium, at a spread premium. So if you could lend money to the government today at 4.25, and you can lend to Apple today at 4.45, right? You're getting a 20 basis points premium by lending to Apple, because the world says Apple is more risky than lending to the US government. But then if you go to a high yield bond, you go to a non-institutional borrower, triple B rated bonds, maybe now instead of 4.45 on your coupon, now you can get 6.50, 6.5% yield on high yield bonds. And so Howard Marks says right now we basically have one of the lowest credit spreads in history. And you have to go back to 2007 when you had this tight of spreads. So credit spreads are very tight and everyone's talking about it. And so it's a scary situation because you think, okay, well, credit spreads are tight. That means that investors are too aggressive. They're overpaying for these bonds. And if these companies default, that credit spread is not going to be enough to cover your default losses, because your recovery rate and so on and so forth. And similar in high yield bonds to multifamily, Howard Marks paints the picture that history has shown that high yield bonds are not as risky as people had made them out to be. And so the premiums, the yield spread that they've been getting was kind of unduly, it was too much. And so now people have gotten wise to it. And so now the spreads are tightened. And the quality of high yield bonds as a whole are higher than before as well, which also contributes to the spread compression. So it's similar situation. Like, you have more liquidity in multifamily than ever, which is a risk mitigating factor to multifamily, which is why you have cap rate compression, because if I buy this deal in Dallas, I'm going to be able to sell it whenever I want. And that's a benefit to me. And therefore, I'm paying a premium for that. So unfortunately, yeah, I think we definitely are in the camp that cap rates are staying low. I don't think they're going higher. I think the peak of cap rates was a year ago.
Which means a couple of things. So just closing thoughts here before we wrap up the show. I don't think we're going to go into, this is my opinion, a GFC-esque situation. I think there's a lot more liquidity in the market, and I don't think cap rates are going to get as wide. What is that going to mean? It means my expectations as an investor shouldn't be perhaps as 30 or 100% return, 50 IRR in a 2-year period, but you're still going to be able to probably likely get a nice modest return because the circumstances aren't as bad for all the reasons we laid out. I do think, either we're in a recession, have been in one, or soon to see one. That's all very real, but don't expect some absurd disproportionate outcome. You will get great returns here coming up, but I wouldn't anticipate, benchmarking it off of what the GFC kind of held from a 2010 to 2012 and 11 return profile. That's just my take. That's just my expectation there, and I hope perhaps you don't expect the world, but maybe perhaps if you play in the market and you take the risks now, you'll be able to have a disproportionate outcome. Any final thoughts here before we wrap up?
No.
Excellent. Well, thank you so much for listening to the show. We've got some great events coming up. Once more, we have our Bay Area West Coast Summit coming up on April 25th. If you think you're going to be an investor, capital raiser, where it would be applicable for you to attend, please email me. And once more, we will have our flagship New York City event, the 5th time we're doing the summit, I believe, coming up here in New York City, September 15th. It's going to be an awesome event. For those who are listening, we appreciate your time, and we'll see you next week.